Here we are with the start of our chapter 16 notes. We're going to be talking about exchange rates, the determination of exchange rates, kind of thinking about how to interpret them, and then also impacts of change, well, what things cause changes in exchange rates, as well as what the impact of changes in exchange rates are. So, what we're going to be doing today, this is in terms of organization. I'm probably going to split the notes into four parts. Um, and this will be the part one notes. And then I will probably do this as part two. This item number four as part three, and item number five here as part four of the notes, just to try to not have me blathering on. One of the things that I'll do, though, in the module is to post the complete set of notes at the end of the module so that you have those rather than having to have all of these little bits as you go through. So what I'd like to do first is to just try to set the stage, and then, as I said, the bulk of what we're going to be doing today is to just be describing what we mean by the foreign exchange market. And again, remember that back when we talked about just the very beginnings of how do we think about the macro economy, we said that there are four big macroeconomic agents interacting in four big macroeconomic markets. So this was our characterization of the economy as a circular flow. So we talked about there being households, firms, governments, and the rest of the world interacting in the market for inputs or the factor market, the market for outputs. So we use that as our way of thinking about gross domestic product. The market for financial assets. So we talked about the financial system in the last notes, and also then just our interactions between the domestic economy and the rest of the world. And the foreign exchange market is a way of capturing those interactions, as we'll see. So what I want to start with, though, is just, again, kind of a broader overview, or continue with the broad overview. So if you've taken a look at chapter 16, you'll know that the chapter vignette opens up with a motivator that involves the Matheson family who grow fruit in the state of Washington in the United States. And there's a description of technological progress in fruit refrigeration, in transportation and communication that opened up markets increasingly for them and of increasing distances and ultimately overseas. So against this backdrop, the Matheson family has had to become conversant in exchange rates and kind of be cognizant of exchange rates as a determinant of their underlying international competitiveness. So that's kind of a microcosm of some of the stuff that we're going to be talking about in these notes. So the rest of section 16.1, which I think you can really just do a very high level skim over because we've talked about most of these things already in the course so far, it goes into some of the broad aspects of trade, including and the idea of globalization, including the importance of reductions in the cost of international transportation and communication that have led to growth in trade. What I want to do at this point is to show you some pictures. Again, these are just pictures in the textbook. You can see the explosion of total global trade in looking at this first graph, which shows total world exports, which also have to be equal to imports, right? So for the whole world, somebody's exports are an import to somebody else as a share of global or world GDP. And you can see, roughly speaking, over the over my lifetime, more than doubling in the amount of global trade from about 12% in 1960 to almost 30% in 2020. This has impacted as well. many countries differently, different proportions, and that's certainly something that we'll turn to in a moment. So the U.S., though, has, of course, experienced globalization. The U.S. trades with many countries in the world, almost all countries in the world, and you can see from this picture the relative proportions. Again, let me say as loudly as I can, I'm not going to ask you on a quiz, what is the proportion of trade that the US does with China? Or tell me about these numbers, 12% to 29%. What I want you to do is just understand that this provides the context for what we're talking about. Um, and so, even though the United States trades with lots of countries, the United States is different from many others. And you can see a further description of this in the textbook, in that while trade for the United States has grown significantly, it is the case that the United States is a relatively closed economy. So global trade, again, more or less over my lifetime, has grown from about 4 or 5% of U.S. imports and exports have grown from about 4 or 5% of GDP to about, on average, about 13 or 14%. Imports, of course, are a higher percentage of GDP, as you can see right there, for the US. But if you look at the material that's in that first section, you'll also know that for the US, this is not a lot of trade compared to, or imports and exports as a percentage of GDP are small for the United States relative to many other countries. And so trade is an important determinant for the performance of the US economy. But many of you may find in your country studies the impact of trade is even more pronounced in the economy that you're investigating because of its higher percentage. So again, this is trade in goods and services, but of course you can recall from our previous set of notes that there's also trade in financial assets. There has been tremendous growth in international financial flows. And again, just as a reminder, what do we mean by what's being traded here? There are three broad categories of financial assets that we can talk about as being traded and falling under this category of global financial flows. One is portfolio investment. So this is purchases of other countries' financial assets, principally stocks and bonds. There are deposits and loans. So in other words, if someone in the US extends a loan to someone in Canada, that would fall into this second category. If somebody in Canada adds to their dollar denominated checking account deposit, that would also fall into this category. So that's what we mean by deposits and loans. And then, of course, the final category is what I'm asking you to focus on for your group project, which is foreign direct investments. So literally setting up a subsidiary in another country. And you can see, and again, these are just pictures that I've pulled from the chapter, the degree to which there's been growth in trade and financial flows, financial assets, broadly defined. So this is all three categories from the previous slide. So for the US, of course, we went from having very little trade in financial assets 60 years ago to with a fairly steady increase, of course, with the 2008 recession, a pretty big drop in them in trade for inflows and outflows, but a leveling out since then. The difference between this picture and this picture, the first one is describing flows. So this is, say, the dollar inflows to the US from the rest of the world per year as a share of gross domestic product. What this is representing is the total stock. And so this is the stock of assets, or the total amount of assets that are U.S. assets owned by foreigners in the blue, and the total stock of foreign assets that are owned by people in the U.S. in the red. And so as we acquire assets, so as say the U.S. Uh, in so let me see. Let me do it this way. As the U.S. purchases assets abroad, in other words, as the flow rises, then the stock of foreign assets owned by the U.S. goes up. And similarly, as the rest of the world purchases financial assets broadly defined from the US, then their holdings, this blue line is going up. So this represents the accumulation. The stock is the accumulation of the flows. And so the expectation in 2020 is this is going to be like in the neighborhood, this one is going to be in the neighborhood of 162% of US gross domestic product. So these financial flows, as we've already talked about, are big and important in terms of contributing to investment and longer term economic growth. What I want to do, however, is return to this in the context of thinking about where we are. So, what our goal is, our principal goal with this set of notes is to, and with the chapter 16 set of notes, is to continue to explore the linkages between imports, exports, and imports and exports broadly defined, and the exchange rate, and to think about how changes in the exchange rate are going to impact the domestic economy. In order to do that, what I want to do is hark back. So what I have done is just reproduce on this slide and the next one, the slides 13 and 14 from the Open Economy macro notes. So in the last week's module, which the broad topic was investment, the middle set of notes were the ones that I had titled Open Economy Macro. And that was pulling from the material in the final section of this chapter, of chapter 16. So it was optional to read then. It is still optional to read, but if you wanted some additional words because I'm not clear, you could go back and look at that. Our goal at the time, in the previous set of notes, was to link net capital inflows and net exports. So what I want to do at this point is to transition from that to the foreign exchange market. So here's how we're going to do this. So remember, our starting point was, suppose you wanted to buy $50 worth of coffee from a farmer in Costa Rica. That farmer then has 50 US dollars. What can the farmer do? The farmer can do one of two things, basically. The farmer can apart from trading the $50 to somebody else in the rest of the world, the farmer could purchase $50 worth of US goods or services. And in that particular case, we can see that the coffee import was balanced by an export, in this case of a good, in the case of a tractor, or a service, in the case of a streaming service. And so there's no net impact on net exports of those two transactions. Alternatively, the farmer could take the $50 and purchase a US financial asset like a treasury bill or shares in Netflix. But in this particular case, then the import of the coffee was balanced by a US export, in this case, of a financial asset. So the coffee, or the good, import is now in this particular case balanced by the export of in this case, a financial asset. And we use that to begin by saying, Oh, well, what we can see is that overall trade has to balance, meaning that for any economy, the total of its exports, so exports of what? Of goods and services on the one hand, and financial assets, has to be equal to its total imports. So again, if you come back over here, in this particular case, we have the import of a good, the coffee, is balanced by the export of a good or service. And so if we come over here with item number one, exports and imports of goods and services are going to balance out. If we compare then our third choice here, so item two, I'm sorry, our third choice here, the export of a good is balanced by the import of a financial asset. So this is what I mean by, again, overall trade has the balance. So we can trade as an economy in goods and services or in financial assets. And so here we are. We're at chapter 16, where we're going to be talking about the foreign exchange market as the mechanism by which that balance is ensured. And so we went on in the prior set of notes, which is what I have just down here in more grayed out stuff. We use that to say net exports is the negative of net capital inflows, and we kind of ran with that for a while. What we're going to do at this point is run with our characterization of the foreign exchange market. So in order to do that, what I have right now is a market that has a demand curve, a supply curve, quantities, and a price. And what I want to do is suggest to you that the foreign exchange market, even though it appears kind of funky because we're trading a currency as opposed to something more tangible, is can be viewed similarly as any kind of micro market that we talked about at the beginning of the semester. So if we take, for example, the market for dog food, right? We would put on the horizontal axis the quantity of dog food. So the quantity of the thing that's being traded in this market, we're trading dollars. In the dog food market, we're trading dog food, of course. We would put the price of what? Of dog food on the vertical axis, and this would be dollars per, say, pound of dog food. Here we have an exchange rate, and this is, in our example here, yen per dollar, and this can be interpreted as the price of the dollar. So the price of dog food is expressed how? It's expressed in dollars. The price of the dollar in this particular case is expressed how? It's expressed in yen. So we have a similar sort of characterization, even though it looks perhaps a little bit peculiar. We have a demand curve and a supply curve in this market, in our dog food market. We have the demand for dog food, and we have the supply of dog food. And we talked about them jointly determining an equilibrium price of dog food and an equilibrium quantity that is traded of dog food. And so we talked in the first part of the semester about what kinds of things might give rise to the demand and the supply of dog food. So on the demand side, the number of buyers, income, tastes, expectations, and so forth, prices of related goods. On the supply side, it was, say, technology, weather, input prices, are twine variables. Our starting point in terms of drawing that analogy on the demand and the supply curve for dollars in the foreign exchange market is to ask, why are dollars demanded or supplied? So let's take the demand side. Why are dollars demanded in the foreign exchange market? Dollars are demanded in the foreign exchange market because people in the rest of the world need to acquire dollars in order to buy dollar denominated goods or services or financial assets. So, specifically, if we're going to talk about the bilateral, meaning two-way exchange rate between Japan and the United States, we would say that the demand for dollars is arising because there are people in Japan who would like to buy dollar denominated goods or services or financial assets, and they need to swap their yen, so they're suppliers of yen and demanders of dollars. On the supply side, we have a similar sort of observation, and that is that dollars are supplied in the foreign exchange market by dollar holders, let's say people in the US, who want to buy foreign currency denominated goods or services or financial assets. So, specifically, again, if we're going to talk about the bilateral exchange rate between Japan and the US, then we would say that the supply of dollars is arising because there are people in the United States who want to purchase, say, a Toyota, where Toyota is denominated in yen. It's a Japanese company, and so someone on their behalf would be supplying dollars in order to acquire yen to make that transaction. Or it might be the case that we might want to buy shares in Toyota, so purchase a financial asset, again, denominated in yen, so we would need to supply dollars in the foreign exchange market to execute that transaction. In the textbook, the authors do not use a notation for the nominal exchange rate. I'm going to, just to save me a little bit of typing, I'll try to write it out, and use this notation of a lowercase e, um, uh, only when it's very obvious what it is that I'm doing. But the nominal exchange rate is just the price. It's just a price at which one currency trades for another. So when we talk about the price of dog food, we're describing the number of dollars that you could get per pound of dog food. The price of the dollar, the exchange rate, is just telling us how many yen can you get per dollar. So the typical setup that we're going to see in the notes is mirrored by what's in the textbook, and that is that we're going to describe the foreign exchange market most of the time from the perspective of the United States, where we're putting the quantity of dollars traded on the foreign exchange market on the horizontal axis and the price of the dollar on the vertical axis. And so that means that most of the time in what we see in our notes, we're going to be describing the nominal exchange rate as units of the foreign currency per dollar, like yen per dollar, euros per dollar, pounds per dollar. And again, our interpretation of this is that this is going to be the price of the dollar. So we can talk about an equilibrium exchange rate. So an equilibrium in our market for dog food, right? Let me go back to this picture. When we talked about the price of dog food, we said an equilibrium price is one in which um, we have an equality between quantity demanded and quantity supplied. And so we can describe the same sort of thing. We have an equilibrium in the foreign exchange market when we have a nominal exchange rate at which the quantity demanded, in this case of dollars, and the quantity supplied of dollars are the same. So let me pause for just 1 second and go back here. We are talking right now about a nominal exchange rate, meaning this is the one you would see if you opened up the newspaper, you went online and said, what is the exchange rate between yen and dollars, or pounds and dollars, and so forth. We are going to talk in the next set of notes. We'll hit on it as the last slide in this set of notes, about a real exchange rate as well. But the nominal exchange rate, just like nominal anything, is the price that you observe in the marketplace place right now. Real is, as we'll see, going to involve an adjustment for the effects of prices. So at this exchange rate of 120 yen per dollar, we could call this, the equilibrium nominal exchange rate. We have an equality between the quantity supplied and quantity demanded of dollars in the foreign exchange market. And so we have that same sort of interpretation. The other thing that we can do once we have an equilibrium exchange rate is that we can convert, or once we know any exchange rate, we can convert foreign prices to their domestic equivalent and vice versa. So, for example, let's suppose that there is a US manufactured shirt and its price is, say, $30 per shirt. If we wanted to know what someone in Japan would pay for that shirt, should it be exported and available for sale to them, we could, given this exchange rate of 120 yen per dollar, figure out the yen price of a US shirt. So the yen price of a US shirt is equal to the number of yen per dollar times the price of the shirt, so dollars per shirt. So in other words, if you think about this, you could cancel out the $2 signs and you would have yen per shirt. So that would be, so this is a US shirt. So what is this? This is the nominal exchange rate times the price of the shirt in the US. Right? So in other words, this is 120 yen per dollar, and the price of the US shirt is $30 per US shirt. And so we could figure out the yen price of the US shirt is 3,600 yen per US shirt. And we'll come back to this in our characterization of appreciation and depreciation. Similarly, we could figure out if there was some Japanese sake, for instance, that cost 2,400 yen per bottle, we could figure out the dollar price of Japanese sake. So here's our second example. And again, there is a purpose to this, as you'll see. So suppose that there is some Japanese sake whose price is 2,400 yen per bottle of sake. Then we could figure out the dollar price of Japanese sake as follows. We can note that that would be the dollars per yen times the number of yen that it costs per bottle. And so what do we have here? Dollars per yen, that's just the inverse of the nominal exchange rate. So 1 over the nominal exchange rate times the price of sake, say in Japan, would give us what we need. So in other words, if this is going to be 1 divided by 120 yen per dollar times 2,400 yen per bottle. And so if we flip this around, this is going to be dollars per 120 yen. So in other words, I'm just flipping the exchange rate times 2,400 yen per bottle of sake. So we could divide through, the yen are going to cancel out. 120 goes into 2400 20 times. And so that would tell me that the dollar price of this Japanese sake is $20 per bottle. So there is one participation question in these notes. Here it is. This is your opportunity to practice with this sort of a calculation, and then we'll come back to consider over and undervaluation. Okay, so what I want to do is consider this idea of exchange rates that are higher than the equilibrium exchange rate involve the dollar being overvalued, and conversely, if the exchange rate is below the equilibrium exchange rate. So in order to do that, let's see if I can pull down, oh dear. Let me see if I can pull down, there we go. So remember in our dog food market, right, if we had, so this is the price of dog food. We have a demand for dog food, the supply of dog food. Right? This is the equilibrium price. And if we had a price up here, right, we noted that, this would involve a situation in which we have a surplus of dog food. This would be the quantity supplied. This would be the quantity demanded at our high price. And if we were to say the price of dog food is too high, the too high, of course, is relative to the equilibrium price. And the price of dog food being too high is going to occur when the price is such that the quantity supplied of dog food is bigger than the quantity demanded of dog food. And if we're saying the price of dog food is too high, this is the same idea as saying dog food is overvalued. Meaning that the number of dollars that it takes to get a pound of dog food is too big. Similarly, we would say that when we have the price of dog food being too low, right? We said a price is too low relative to the equilibrium price when we have the quantity supplied less than the quantity demanded, or in other words, a shortage. And we would have said in that context, we didn't, but we could have said that dog food, the price of dog food, or dog food itself, is undervalued. Well, that's the same thing that we have now in this marketplace. So in the foreign exchange market, when we have a price, say, of dollars, so again, this exchange rate is just the price of the US dollar. When the exchange rate is bigger than the equilibrium one, so E bigger than E star, is telling me that the dollar is overvalued. And we say that's too high of an exchange rate because just like in our market for dog food, the quantity supplied right there is going to be bigger than the quantity demanded of dollars at that exchange rate. So an overvalued currency is one in which the nominal exchange rate, at least in nominal terms, a currency is overvalued when its price is too high, or in other words, when there is a surplus of that currency in the foreign exchange market. And the price being too low would be the opposite. And we would talk about the adjustment to the equilibrium involving the surplus in, say, when the exchange rate is 150 yen per dollar, the surplus putting downward pressure on the exchange rate, and we would imagine a movement along these curves to the new equilibrium. In order to describe that adjustment process, we need to kind of think about what the relationship is to changes in what the relationship between changes in the exchange rate and trade patterns actually is. So we're going to turn to that in a couple of slides, but what I want to do first is to note that just as, again, in the market for dog food, if we said the demand for dog food shifts to the right, you would know, oh, okay, other things equal, the price of dog food is going to go up. Or, in other words, dog food is going to appreciate. And so that is what we're turning to here. If we were to see an increase in the demand for dollars, it's exactly the same kind of thing. If the demand for dollars were to shift out to the right in this direction, you would see that there would be a higher equilibrium exchange rate. Similarly, if the supply of dollars were to shift to the left, then there would also be a higher equilibrium exchange rate. And then conversely, a decrease in the demand for dollars or an increase in the supply of dollars, or both, would cause the nominal exchange rate to fall. In the first case, in the case that we have here in the notes, if there is a rightward shift in the demand for dollars, so in other words, let me just sort of sketch this over here so as to not muck up our picture. So this is the quantity of dollars. This is the exchange rate, say yen per dollar. If this is the initial demand curve and the new demand curve shifts out to the right like that, then we can confidently say that the exchange rate is going to go from E0 star to E star 1. So this movement of the exchange rate in an upward direction is going to be an appreciation of the dollar relative to the yen. Because what it's saying is that if this is, say, 120, and then it goes to 150, then what we're saying is this appreciation means we get, of course, more yen per dollar. And so the language for that is appreciation. So a currency appreciation is occurring when there's an increase in the value of one currency relative to another. And in this particular case, for instance, if the dollar is able to obtain and trade more yen. A currency depreciation is the opposite, when there's a decrease in the market value of one currency relative to another, or in other words, if we had a currency depreciation, there would be a decrease in the number of yen per dollar. So in other words, if the exchange rate went from 100 yen per dollar to, well, actually, sorry, if the exchange rate went from, to be consistent with the picture up above, 120 yen per dollar to 100 yen per dollar, that would be an example of a depreciation of the dollar relative to the yen. Every $1 given up would obtain fewer yen. So what I have here in a picture is just an illustration of this from a particular time period. So we have in the blue exchange rates, sorry, this is units of foreign currency per US dollar. So in our depiction earlier, this would be the E. And so this is the blue exchange rates are for October of 2011, and the green exchange rates, these ones are for November of 2012. And what we have here is just the inverse of this. So this is 1 over E here and here, again in October of 2011 and November of 2012. And so what you can see, first of all, is that indeed, if we want to talk about the price of the dollar is the US dollar would be, say, yen per dollar. And if you take the reciprocal, so in this particular case, if you take the reciprocal of 0.9927, so not yen, Canadian dollars, so this is equal to 1 over 0.9927. And you can verify that there might be some rounding, but that's what's happening in the right-hand most two columns. So this number would be 1 over 1.023, for instance. So what can you observe? You can observe that, of course, these exchange rates change from 2011 to 2012. Sometimes in bilateral terms, the dollar appreciates and sometimes it depreciates. So red-filled red, we should be viewing with generous spirit. So this is red. This would be an instance in which we get, say, fewer Canadian dollars per US dollar, and we get fewer Mexican pesos per US dollar and fewer British pound per US dollar. And so that this represents a depreciation of the dollar relative to the US dollar, relative to the Canadian dollar, the Mexican peso, and the British pound. Sorry if there's ambient noise. My dog is kind of going nuts right now. Then what we have in green, so we'll make that a squiggly line here and here, represent a appreciation of the dollar relative to the yen, right? First you get almost 77 yen per dollar, then it becomes almost 82 yen per dollar. And for the euro, it's similar. You get about 70.73 euros per dollar in 2011 and almost 0.77 euros per dollar in 2012. So that represents an appreciation of the dollar relative to the yen and the euro. And note that is just really saying the opposite, that when the dollar is appreciating relative to a specific currency, that other currency is depreciating relative to the dollar. So, for instance, we notice that the dollar is appreciating relative to the yen is depreciating relative to the dollar. So we go from 0.013 dollars per yen to 0.0122 dollars per yen. And similarly for the euro. And then as well, just to try and be as clear as possible, where the dollar is depreciating relative to the Mexican peso, the peso is appreciating relative to the dollar. So initially in 2011, it was about not quite 7.5 cents per Mexican peso. In 2012, it was more than 7.5 cents per Mexican peso. So this is an appreciation of, this is an appreciation of the peso relative to the US dollar, and this is a depreciation of the US dollar relative to the peso. Okay, so it's just you're going to see the flip side of this. Now, there's lots of different ways to describe currency fluctuations. Higher price of the dollar is the dollar appreciating, and so forth. You can read through this. This, rather than the previous slide, which showed bilateral exchange rates, this shows an index of the dollar relative to the currencies of the U.S.'s major trading partners, and you can see this broad trend of the dollar appreciating to roughly the early 2000s, and then a depreciation relative to other currencies to the roughly the financial crisis, and then an appreciation through the present, as we're going to see in a subsequent slide later on. The last thing that I want to do in this set of notes is to consider the impacts of changes in exchange rates. So one of the things that we'll do in the third set of notes is actually ask, why does the demand for a country's currency or the supply of a country's currency change? So we'll save that for later. And right now what we'll say is, suppose that they did and that there's a change in the nominal exchange rate. What happens? Well, one thing that we can predict would happen is that it could affect international trade flows. And so let's go back to our example that we had before. Let's suppose that initially the exchange rate is 120 yen per dollar, and that the dollar depreciates relative to the yen for reasons that we won't worry about right now. But from 120 yen per dollar to 100 yen per dollar. So in other words, we get fewer yen per dollar, and so this is a dollar depreciation. We saw in our earlier example that if we had a US shirt that had a price of $30, when the exchange rate is 120 yen per dollar, the yen price of that US shirt is 3,600 yen. What happens now? Well, if we wanted to think about the consequences of the depreciation of the dollar, what we could recognize is that after the dollar depreciates, the yen price of this shirt is going to fall. So the yen, so what I'm going to do here, the yen price of the US shirt, we said was the exchange rate times the price of I forget which way I wrote this, it doesn't matter for what we're doing, the price of the shirt in the US. So the exchange rate is now 100 yen per dollar times $30 per shirt. And so that gives us this yen price of 3,000 yen to get this US shirt. So we could put US in here if that helps. And so what do we observe? The dollar depreciation makes US goods relatively cheaper in Japan. And then more generally, if the dollar depreciated broadly, it would make US goods and services relatively cheaper in the rest of the world. Similarly, we saw that if there was this 2,400 yen bottle of Japanese sake, when the exchange rate was 120 yen per dollar, it would cost someone in the US $20 to buy that bottle of sake. But if it is the case that the dollar depreciates, then someone in the US needs $24 to buy the sake. So again, the way to think about this would be we'll come up here to get a little bit more space. The dollar price of sake is equal to 1 over the nominal exchange rate times the price of, in Japan, in this case, of sake. And so this would be 1 over 100 yen per dollar times 2,400 yen. So stick the yen sign in there, but divide 2,400 by 100, and you come up with this $24 to buy the bottle of sake. And so the dollar depreciation serves to make the rest of the world's goods relatively more expensive from the perspective of those in the US. So, what would we conclude? We would conclude, all else equal, which is always a biggie, if it is the case that we have a dollar depreciation, we should see two things happening. One is, other things equal, it should serve to increase US exports of goods and services to the rest of the world. Um, so, of goods and services. And it should serve to decrease US imports. Oh, my dog. Imports of goods and services from the rest of the world. Why? Again, US stuff becomes relatively cheaper from the perspective of the rest of the world, and US and the rest of the world's stuff becomes relatively more expensive from the perspective of those in the US. And so, other things equal, higher exports, lower imports should together be something that causes net exports in the US of goods and services to go up. And if net exports in the US go up, then that would be something that we might predict would increase gross domestic product, all other things equal, right? Because Y is equal to C plus I plus G plus NX. And if net exports is going up, then again, other things equal, gross domestic product would be going up. So the bigger impact is going to happen the more open the economy is to trade. So depending on the degree to which the economy is open to trade. And so the obvious question is, why wouldn't a country always try to drive its currency lower? If it's going to stimulate trade, that seems like an easy way to stimulate growth. But as with all things in economics, there are trade-offs, and we'll get to this at the end of this set of notes. We have to also recognize capital flows, but there are other even more substantive trade-offs. Um, but the other thing to recognize is that what is also going to matter in this all else equal sort of discussion is that what really is going to drive, really in fact, is going to drive trade flows is the real exchange rate. So the real exchange rate is going to be a measure of international competitiveness vis-a-vis the rest of the world. And as we are going to see, the real exchange rate is going to be the nominal exchange rate adjusted for differences in prices in the respective economies. So this is what we're going to start with in the next vignette of notes. But what I want to suggest to you is that if a nominal depreciation, meaning, in other words, a decrease in E of the dollar occurs, if there is a nominal depreciation of the US dollar, also leads to a real depreciation, then we would predict higher net exports of goods and services to the US. So our task is to explain why this is. That'll be the next set of notes. And then the third set of notes after that will get at what kinds of things will drive a country's currency in nominal terms, higher or lower. And then the final set of notes will give us some insight into what the trade-offs are in having persistent depreciations in a country's currency. So we'll check in just a little while.